Hello again, and back by, I guess, somewhat popular demand. Here we are to go through Chapter 3, the Accounting Information System, Week 3's material. In this chapter, we'll look at the nuts and bolts of the accounting information system, which in today's world is almost always computerized, at least to some degree. Excuse me. Well, here are the objectives for this chapter as shown in the text. We've kind of set the table for this chapter with what we've already covered. For example, the basic accounting equation, assets equals liabilities plus owner's equity. But now we're going to go into more details. This is where accounting classes a generation ago started, with transactions, debits and credits, how the accounting equation was impacted, and then on to closing a period and preparing financial statements. I've got my trusty little whiteboard with me here. I've had some feedback that it might be helpful to actually go through a few little examples, I guess, maybe to kind of expand on what's covered in the text, and I think we'll try to do that in this one because of all the details we're going to cover. Along the way, we'll discuss journals and journal entries, ledgers, postings, and the trial balance prepared at month end to ensure that debits equal credits before going ahead with financial statement preparation. So this is all the behind the scenes stuff that occurs before those financial statements that we talked about in chapters 1 and 2 are actually prepared. Going to slide 4. This chart, of course, presented in the text also. It gives you a snapshot of what we'll cover in this chapter. It's found on page 102. We'll take a look at accounts, transactions, recording of transactions, and how all of that feeds into the month-end financial closing process. The accounting system is designed to collect and process accounting transaction data and then process that data into meaningful financial information for users, that is, the financial statements. And on to slide 6, a transaction is an economic event. If such an event did not occur, then we don't have an accounting transaction. As the slide tells us, there is a dual effect on the basic accounting equation, assets equals liabilities plus owner's equity, for each transaction. This is because at the end of the recording of each transaction, the equation still must hold true. That is, both sides must stay equal. We're going to go through a lot of examples that prove that out as we go along here. Now on slide 7, look at the example in this slide to understand why the discussion of a guided trip in itself is not an economic event and therefore doesn't get recorded as an accounting transaction. Moving on to slide 8, as stated on page 103 of the text, analyzing transactions, each transaction has an impact on the accounting equation, but should never cause the equation to be out of balance. For instance, a transaction that increases an individual asset can only do the following. Number 1, decrease another asset, or number 2, increase a liability, or number 3, increase stockholders' equity. On slide 10, in the example on this slide, cash was received in exchange for shares in the company's common stock. Therefore, cash increased by the $10,000 received, and common stock, an equity account, also increased by $10,000. Note that this kept the basic accounting equation in balance. Now, in a little bit, we in the text are going to use these things called T accounts. And for some reason, this does not want to write. So, sorry if that doesn't translate out that well to the screen, but what I'm showing you is that cash was debited, or the left side of the T account, for $10,000 in this transaction. Common stock was credited for $10,000, or the right side of the T account. See if I can find something that writes better. And we'll move on. On slide 11, in the transaction shown on this slide, cash again increases because the company receives cash proceeds from borrowing on a note. That is, a promise to pay back the borrowed money in the future. In this case, liabilities increase by the same amount since the company has incurred a debt with the bank. So I'll see if I have a little bit better luck with the ink on this one. Yeah. So here we have a transaction for $5,000, and $5,000 of cash came in as a result of borrowing on this note. So here again, cash is debited, or the left side of the T account is increased by $5,000. Notes payable, the liability account, is credited for that same $5,000. And in that way, you can see that the accounting equation remains intact. That is, assets still equal liabilities plus owner's equity, since both sides of the equation went up by the same amount. Alright, moving on to slide 12. In this case, they purchased equipment by paying $5,000 cash. So in this case, we're going to have some cash going out the door to buy the equipment. Cash decreases by the $5,000. Now, another asset, though, equipment, increases by the same amount to recognize the purchase of the equipment item to be used in the business. So the accounting equation stays in balance since the total assets balance remains unchanged. We have a $5,000 decrease in one asset, cash. We have a $5,000 increase in the other one, equipment. The next one on slide 13, Sierra received a $1,200 cash advance from our NOXA client. So cash advance is a little trickier. In this case, you're increasing the cash balance because you've received cash from a customer. But the company hasn't provided a product or service for the cash received yet. So therefore it has to recognize a liability for the goods or services that it owes to the customer. That means a liability called unearned revenue is increased and the accounting equation remains in balance. So let's take a quick look at that one. In this case, we receive cash of $1,200, so we're still going to show that as a debit. But now we have this liability called unearned revenue because we have not done anything as a company yet to earn that customer's money. I'm sorry, it looks like a $6,200 there in cash, but it's really a comma there. $1,200 debit to cash, credit, unearned revenue, it's the same $1,200. Okay? Next, on slide 14, cash came in for a service rendered. Therefore, the cash increase is accompanied by an increase in revenue, since the service was performed this time in exchange for the cash. Since an increase in revenue will cause ultimately the retained earnings balance portion of stockholders' equity to increase, the accounting equation remains in balance. And notice on this slide how we're getting into a little bit more detail here in showing the various types of assets, liabilities, and stockholders' equity and the impacts on each with these transactions. Slide 15, paying the rent causes cash to decrease. At the same time, an expense has been incurred, and this increases expenses, which at the same time has a negative impact on retained earnings. That is, it ultimately reduces income, and therefore it has a negative impact on stockholders' equity as well, and that's what's being shown here. So once again, the equation remains in balance as a result of this transaction. On slide 16, a purchase of insurance coverage is usually paid in advance for a time period to be covered, often more than a year. Therefore, the asset account associated with this transaction, besides the decrease in cash, is referred to as prepaid insurance. So as one asset decreases, that is cash, another increases by the same amount, that is prepaid insurance. At the end of the period, the amount of insurance coverage used will be expensed, and the prepaid asset account will be reduced by the amount of the expense. So again, here we have $600 decrease in cash, and we have an increase to the asset account prepaid insurance, or a debit of $600, as shown in these T accounts. Okay? I hope that's more of a help than a distraction, continuing to go to that board, but you can certainly give me feedback on that. Going to slide 17. Supplies are an asset of the company until they're used. Therefore, the supplies account increases when supplies are purchased. However, when the supplies are purchased on account, the company owes the supplier money, and this is reflected as a liability called accounts payable. Thus, the increase in assets and liabilities, again, is equal for this transaction. Credit to cash, debit to supplies, an asset account, credit to accounts payable, a liability. Slide 18, the payment of a dividend decreases cash on hand and also decreases retained earnings. Remember from Chapter 2 that dividends paid are reflected on the retained earnings statement as a subtraction or a deduction. Therefore, we have a corresponding decrease in assets and stockholders' equity. In this case, on slide 19, employees have worked 2 weeks and they've earned $4,000 in salaries, which were paid on October 26th. So in this case, the cash paid out for salaries reduces that asset and results in a corresponding expense. That reduces ultimately retained earnings and therefore stockholders' equity. The point of this little vignette is that errors can result even if we thought we did everything right and everything balances at year end. Transactions may not be recorded at all, for example, which would not throw off the accounting equation's balance but would still cause a misstatement. See page 158 in the text for further explanation of what could have happened to cause errors. And with that, I'll close this part of the presentation.